Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. 1.1, Accounting Concepts. Part 2. Welcome to today's deep dive into the world of accounting, where we'll explore the fundamental concepts that underpin financial transactions and the systems used to record, summarize, and analyze them. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are an auditor, this journey will shed light on the often complex systems that drive decision making. Financial reporting is like a universal language for businesses. To truly grasp its significance, let's take a journey through the key principles that govern it, illustrating how they act as the foundation for transparency, trust, and clarity in financial data. At the heart of financial reporting lies generally accepted accounting principles, commonly referred to as GAAP. Think of GAAP as a rulebook for organizing financial transactions. Each activity, from a massive acquisition to the purchase of office supplies, is meticulously categorized and reported. This rulebook ensures that a company's financial story can be easily understood and trusted. However, over time, GAAP has evolved differently in various countries, much like regional dialects of a common language. Imagine trying to compare a story written in English and another in Spanish without a translator. This complexity has made it challenging for businesses and investors to interpret financial data across borders. To solve this, international organizations have been striving to harmonize these differences, resulting in the creation of the International Financial Reporting Standards, IFRS. Formed in 2001, the IFRS Foundation seeks to write a universal language for accounting, aiming for standards that are high quality, understandable, enforceable, and accepted worldwide. Today, over 140 countries have adopted IFRS, creating a global pathway for transparency and comparability. Imagine opening two books written by authors from opposite ends of the world, only to find they use the exact same rules to craft their narrative. That's the power of IFRS in cross-border commerce and investment. Yet some regions, like the United States, prefer their own GAAP, which reflects local preferences but occasionally adds hurdles to global comparison. To make financial reporting truly useful, accountants follow key qualitative characteristics that enhance the value of this information. First is relevance. Think of this as picking the parts of a story that matter most to the decisions of its readers. For instance, financial data that has predictive value, helping investors forecast future trends, or confirmatory value, validating past predictions, makes it significantly impactful. However, relevance also comes with a critical caveat: materiality. This trait acts like a spotlight, ensuring only significant details, those capable of influencing decisions, are highlighted and not buried under trivial figures. Equally essential is faithful representation, which assures that what is portrayed truly mirrors reality. A faithful financial report is complete, unbiased, and free of error. Imagine describing a landscape. If you omit key details like the presence of a vast lake or intentionally distort it, the image painted becomes unreliable. Similarly, financial information must capture the full picture while remaining unbiased and formulated with precision. Beyond this, comparability and consistency make financial reports useful tools for comparing entities or analyzing trends within a single organization over time. It's like flipping through an artist's work from one era to another. You'd want to see the evolution without discrepancies in style confusing the narrative. Verifiability acts as a credibility booster, ensuring that independent observers can reach a consensus that the financial data accurately represents reality. This characteristic is indispensable for fostering trust in financial documents. Meanwhile, timeliness ensures decisions are guided by fresh and timely information rather than outdated data. Think of it as reading the latest edition of a book to fully grasp its relevance to current events. Lastly, understandability ensures that financial reports are clear and concise, but not oversimplified, a balancing act to make even complex financial data accessible to a reasonable user. A company's financial health is underpinned by its ability to continue operating, a principle known as the going concern assumption. This concept ensures users plan with the assumption that the business will persist far into the future unless explicitly stated otherwise. Just as a climber assesses whether they can reach the summit or should signal distress, management must transparently disclose when events jeopardize this ability. At the core of every financial report are elements such as assets, liabilities, income, and expenses. The recognition of these involves stringent criteria, much like admitting someone into an exclusive club. For example, recognizing an asset requires it to likely bring an economic benefit to the entity and that its value can be reliably measured. These principles ensure that reported items embody substance rather than speculation. Consider a company winning a lawsuit. Notes: while it might qualify as an asset in principle, if its value can't be reliably estimated, it won't be recognized formally but can still be disclosed in supporting notes. When it comes to recognizing income or expenses, the concept of economic benefits takes center stage. Income is recorded when it increases assets or decreases liabilities, and the reverse is true for expenses. This dynamic interplay ensures that financial statements align with reality. For instance, revenue is typically recognized when goods or services are delivered, reflecting the transfer of promised value. For expenses, the process often employs the matching principle, which pairs costs and revenues directly. Think of it as connecting each train car to the locomotive, creating a coherent chain of events. Over time, the systematic allocation of costs, like depreciation, ensures that expenses are evenly spread across relevant accounting periods. Finally, measurements bring it all together. Whether recorded at historical cost, original payment value, current replacement cost, today's cost to replace, or realizable value, sale proceeds, these bases provide diverse perspectives on financial worth. Measurement grounds financial statements in accurate and reliable representations of value, ensuring users have a solid framework for their decisions. And so, financial reporting weaves an intricate yet beautifully structured narrative, a language that bridges entities, builds trust, and equips decision makers for the financial landscapes ahead. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.